How to choose winning stocks. There are thousands of stocks listed on the stock exchanges, so how do you pick the winning stocks from the abundance of stocks in the market? It is a difficult task, but not an impossible one. You need to know how to go about the task to be able to zero in on the winners. As the race for picking, India has bought a processed approach for its readers to guide them through the selection of winning stocks. This video and slide includes a step-by-step approach, which one needs to follow for picking up winning stocks in the market. These criteria include: 1. The nature of business that the company is engaged in. 3. Pricing power it enjoys in the market for its products. 4. Quality, bandwidth, and the track record of the company's management. 5. Capital intensity of the business the company is engaged in. 6. CAGR of its sales. 7. Operate on capital employed ROAS generated by the company. 9. CFO EBITDA and debt equity ratios. 10. EBITDA and PAT margins and asset turnover ratio. If the company comes out with flying colors on all these criteria, you can be sure that it is a winning stock. Highlight an enemy of bad ones. In 25 years, successful companies grow to unimaginable levels in sales, profits and market cap. Out of the top 500 companies listed in 1995, only 100 companies have outperformed the benchmark index until 2020. Over 50% of the current market cap is made up of the listings post-1995. Equity investing is a complex process. A thorough and robust approach is required to pick up winning stocks. In this white paper, Dalal Street Investment Journal is of picking up winning stocks. The Code of Great, Good, Gruesome. The Code of Great, Good, Gruesome discussed by Warren Buffett in the 2007 Berkshire Hathaway annual report is very illustrative as to how an investor should look at a business investing. In his letter to the shareholders, sorting companies into 3 categories. For a business to be considered great, 1. It must have an enduring moat that protects the excellent returns on invested capital, which is only possible if a company possesses a powerful brand or a low-cost producer. 2. Such companies years but do so while consuming significantly less capital over time. 3. In the long run, given the power of compounding, these companies are cash machines. Meanwhile, a good company, 1. is able to enjoy a competitive advantage and make healthy rates but need a large increase in capital infusion to sustain their growth. 3. A significant proportion of the profits, therefore, need to be reinvested back into the company. 4. As compared to great companies, return ratios will tend to be much lower, and a gruesome company, 1. may showcase a high growth rate but require significant capital for such growth, and then earn little or no money. 2. Investors pour in money attracted by growth but just end up eroding their capital. 3. Although the ROE does help to look at companies based on other qualitative parameters as well. A. Nature of business. 1. The nature of business refers to the overall activities of a company in their quest to create, market, and sell a service or a product. 2. Ideally change at all and has high stability. However, in reality, businesses have always changed with the times. 3. Innovation, especially through technology, contributes to these changes. 4. A great company is the one that will see the comparison will see moderate change, while a gruesome company will experience rapid changes that damage business prospects. B. Competitive advantage. 1. A competitive advantage is an attribute that enables a company to outperform its competitors. 2. This allows a company to achieve superior margins compared to its shareholders. 3. It must be one that is difficult, if not impossible, to replicate. Some of the examples are access to highly skilled labor, the ability to manufacture at the lowest cost, strong brand recognition, access to a patent or proprietary technology. ranging from brand recognition to the lowest cost of production. 5. This is seen on a moderate level in good companies, whereas a gruesome company will have little or no competitive advantage. 6. The business in the gruesome category is easily replicable and has few barriers to entry. C. Prices without causing a decrease in demand for the products, has a major advantage over its peers. 2. Ultimately, pricing power is generally determined by how unique or essential a product is in the eyes of customers. 3. A great company will have a high pricing power, the ability to raise prices without impacting the customer relationship. 4. Thus, they are able to stabilize the revenue of the business, maximize profits, and maintain a predictable growth rate. 5. A good business might have some pricing power, but this is completely absent in the case of a gruesome business. E.g. management. 1. Often the track record of the management and promoters are heavily scrutinized during the analysis of a company. 2. While it's true that quality management is essential to the smooth running of a profitable organization, great companies have less dependence on this quality simply because the nature of the business and competitive advantages are so. Quality of the management plays a decisive role in the success of the firm. On the other end of the scale, a gruesome company has a very high dependence on the quality of management. Capital intensity. 1. Capital intensity is the infusion of high amounts of capital in a business or production process. Portion of fixed assets, land, property, plant, and equipment to produce goods and services. 3. Typically, a great business will have low capital intensity and a high level of intangible assets. 4. A good business might see moderate to high capital intensity, while a gruesome business is capital. Out of the 3, we know that the gruesome business is the worst sort of business, one that grows rapidly, requires significant capital to engender growth, and then earns little or no money. Hence, such businesses must be avoided no matter how cheap they appear. The set of quantitative parameters for shortlisting the best companies. Here are the 7 quantitative factors you should be focused on. F. Sales growth. 1. The top line of the company is the first important aspect of picking up winning stocks. 2. The importance of sales growth is sales growth rate over a period of 3 to 5 years gives you a very good idea if there is a growing demand for the company's product or service. 4. You should be wary of the company's growth rate, i.e. dwindling, especially when the economy is booming. This can be an indicator stating that the firm is stagnant. Hence, look for companies growing at a 10% or CAGR for the last 5 years. Cash flows. 1. For every business, the cash flowing into a company is essential for covering the day-to-day expenses necessary to operate a business. 2. It keeps lights on and doors open. 3. An investor should always prefer a company which has strong, healthy, and increasing operating cash flow. 4. Companies new to the markets may have negative cash flows in the beginning as the expenses might be more than the income. 5. However, as the company matures, they makes them profitable. 6. A red flag here for the investors is that they should not invest in companies posting negative cash flows for many years. 7. The company should have no sustained negative free cash flows, which means that it shouldn't be a capital guzzler. Return on capital employed raising a company's profitability and capital efficiency. 2. In other words, this ratio can help to understand how well a company is generating profits from its capital as it is put to use. 3. The formula for calculating this ratio is EBIT, capital employed. 4. EBIT employed is total assets current liabilities. 5. For picking up winning stocks, one has to make sure that this ratio is at least 15% or on an average for the last 5 years. ICFO to EBITDA. 1. Fraudulent companies can cook their books in several ways. 1. 2. Companies can resort to such practices through channel stuffing, providing extended credit periods, etc. 3. One ratio that can help in spotting such companies is CFO to EBITDA, earnings before interest, taxes, depreciation and amortization. Cash manipulate. For a CFO to EBITDA ratio of significantly less than 1 for an extended period can mean that the company is not able